So in November of 2025, Kimberly Clark made an acquisition or announced an acquisition of Kenvue, where they will pay $3.50 in cash and 0.14625 shares of Kimberly Clark common stock. And so most of the value in the acquisition for Kenvue shareholders will come via Kimberly Clark stock. And so investors are asking me, what should they do with Kenvue? Is it a buy, hold, or sell following the announcement? And remember, these announcements of acquisitions don't always complete. Sometimes there are regulatory concerns that restrict the companies from making and completing the acquisition. And so you still want to know if it doesn't fall through, or if it falls through, if you are left holding Kenvue shares, if that's something you would want to own. And so I'm going to break that down for you in this video, highlight some of the details, and answer the question on what you should do with Kenvue stock.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/partkev for the 10 best stocks to buy now.
So remember, Kenvue was spun out of Johnson & Johnson, and that was actually one of the rationales for Kimberly Clark making this acquisition, is that Kenvue is not operating efficiently, right? They were spun off from Johnson & Johnson, and so the business hasn't really been formed in a way that optimizes its operations. And Kimberly Clark, meanwhile, is a much larger company with better operations, and it thinks that it can make significant improvements to Kenvue's business, and it found that there are synergies available. For instance, Kenvue has better operations in India, whereas Kimberly Clark has better operations in China and Indonesia, and they feel that merging the companies together will bring forth a better overall company, a better overall business. And I tend to agree with these acquisitions, especially with these kinds of companies. You benefit from those economies in scale, and you also benefit from the reduction of some redundancies, right? If Kenvue has a whole financial department with accountants and CPAs, etc., and Kimberly Clark also has the whole financial department with CPAs, accountants, etc., you don't need two teams doing the same thing, right? So you can combine the companies and they can operate with one accounting department or one finance department, and that removes some redundancies from the business. And you can go on with every category, right? You can do that with human resources, you can do that with marketing, you can do that with infrastructure technology, you can do that with the board of directors, you could do that with the management team, with the headquarters, etc., etc. And so combining companies usually creates synergies that lead to better profits compared to if these two companies were operating separately. And so from 2019 to 2025, Kenvue's revenue has increased from 14.3 billion to 15 billion, relatively slow growth, and Kimberly Clark feels that it can help the company grow. The combined company will grow better than if they were separate companies. And then looking at the returns on invested capital for Kenvue, these were not very good figures. The company has not generated a return on invested capital of over 10% in any single year. Really, really low levels here, close to or below its weighted average cost of capital. So this isn't a company that's operating extremely efficiently. And so an acquisition and making the assumption that with the acquisition, the company can operate more efficiently, I think is a reasonable assumption to make, because when you look at the numbers, it's true. There is room for improvement. There is significant room for improvement. And a similar number here with the cash flow to sales ratio, which has actually been trending downward from 21% in 2019 to 14%. Now, this is a reasonable number. It's not a poor number like the return on invested capital, but the trend is troubling. And then looking at valuation, Kenvue, I think, is attractively valued, trading at a forward PE of 15 and a forward price to operating cash flow of 13. So I feel Kimberly Clark is I mean, if you look at the offer from Kimberly Clark when they made the offer, based on Kimberly Clark's stock price at the time of the offer, they were basically offering $21 per share for Kenvue. But now, since Kimberly Clark's stock price has fallen since then, the offer is about $19 per share for Kenvue. And right now, Kenvue is trading at $17 per share. So they're paying about a 20% premium to acquire Kenvue stock, which I believe is undervalued at the current market prices. Whether we look at the market multiple or the intrinsic value per share, I calculated at $24 for Kenvue. Now, if you own Kenvue stock right now, you're getting a few dollars in cash. I believe it was $3.50 in cash. And then the bulk of the value you're getting is in Kimberly Clark stock. So it's important to understand the valuation for Kimberly Clark because you'll be getting a lot of their share price. And I updated my calculation for the intrinsic value for Kimberly Clark. And I also believe Kimberly Clark is undervalued. This is a stock I've been recommending as an undervalued dividend stock because of the significant undervaluation. The market price is 106. The intrinsic value is 194. And this is after I adjusted the company's beta higher. It operates on a very low beta, and beta is a measurement of risk. And these companies are less risky than the average company because healthcare, in the personal care and healthcare categories they operate, and the non-discretionary type of products they sell, people buy their products whether or not they have good job prospects or they're getting a raise or not getting a raise. These are things people buy regardless. It's not dependent on the economy. It's like the opposite of a car company. A car company is extremely dependent on the state of the economy. When more people are getting jobs, those people are going out and buying cars because they now want better transportation. Or if they get a better job, they trade in their car for a better car. Very dependent on the performance of the macroeconomy, which makes them riskier, more volatile. It's the opposite for Kenvue and Kimberly Clark. These are almost independent. Well, I shouldn't say independent, but closer to being independent to the performance of the macroeconomy, which makes them less risky, less volatile. It's a needs-based business, not a business based on what a person's income or income growth trajectory looks like. So even if you're getting shares of Kimberly Clark, it's an attractive valuation for Kimberly Clark. And so as a Kenvue shareholder, I think you're well positioned here owning the stock. And even if the deal falls through and you end up being stuck with Kenvue stock, I think it's undervalued at $17. So it's okay to own those shares. And then if the acquisition goes through, and you get shares of Kimberly Clark, that's also a stock that I think is undervalued. So either way, I think you're in a good position here with Kenvue stock. Hey, if you value my process for researching stocks, I think you'll appreciate access to my spreadsheet containing my discounted cash flow valuations, which calculate a fair value for over 200 companies. It answers the question, what's a good price to pay for a certain stock? You can get access by joining our channel at the investor tier or above. See the link in the description or click the join button below to learn more.